Welcome to the Deal Flow podcast. So this week, we're going to be reviewing a few deals across the Carolinas and Alabama. One that we're going to be aggressively pursuing, and a couple that are a little bit outside of our wheelhouse so far as size, but we'll be able to walk through them all and give you guys a sense of what's happening in the market, what are we seeing that's positive, what's negative, what we're pursuing, and what we're saying no to. Let's get into it. Okay, so the first asset we have that we're going to be looking at today is in the Carolinas, North Carolina specifically. This is a marketed deal. It's a little bit outside of our wheelhouse so far as size. This is a little bit over around a $50 million asking price, 250 or so units. Average unit size is over 1,000 per square feet. Vintage is 90s, 2000. Good asset, good size, great market. If I look at the demos for this one, we've got strong population growth. We're talking about a 50% growth in the last 20 years, good unemployment rate. Schools are decent, definitely meet these standards, but they're not excellent. Crime is fine and within tolerance. So all in all, really good. And the income here is just really strong. So we're talking almost $100,000 income, and then some of the surrounding areas are even stronger. What I will note is that in this particular area, there is pretty big differences in income between the 1, 3, 5 mile radius. So we're looking at a very attractive pocket in perhaps a area with some in the 3 and 5 mile radius is a little bit worse. That's not necessarily a bad thing. We actually see that as a positive. We want to be in the best areas. Typically, we do see that results in better school districts and things like that. And then as long as that 3 and 5 mile radius still meets our standards, that's a good sign. Now, if we have really strong income in 1 mile and then the 3 and 5 is below our standard of about $60,000 income, then that's something to be concerned about. But all the areas we're talking about $70,000 income or higher. So really strong. Also in this 1 mile radius that we really find to be attractive is this is a mostly owner occupied property. So we're looking at a low 20s% of the housing stock that are rentals in the 1 mile radius versus say 35 or 40% in the 3 and the 5. And then that's more normal. So really strong house ownership in the area, which is a good sign typically. So all signs point to this is somewhere we want to be, at least from a desktop perspective, be operating in. When we look at valuation, this property was purchased about 5 years ago, and they got it they're all in for about $125 a square foot at that point, and they're looking to sell for $175 a square foot, give or take. Good rents here. There's not a massive value add, but it's a strong performing property as it is. Nice going in cap rate. We're not quite where we want to be, or they are not at the price that we would want to pay at. And so with where their ask is, we're just not quite there on the IRR targets that we need to hit and the cash on cash. We would be about 90 cents in the dollar on this one, but in the current market, that's relatively competitive. So I wouldn't be surprised that at 90 cents in the dollar, we would at least be pretty darn close to the cutoff. And then we would determine whether or not we wanted to stretch. But like I said, this is at the high end of our ability. It's almost a $20 million equity check. So given the size of the deal, although everything else checks out, this is probably not something we're going to be able to tackle right now with other things that we have going on. Taxes, insurance had been adjusted. Insurance in this area is still pretty attractive relative to some other areas. They're currently paying under $300 a square foot. A unit, under $300 a unit for insurance. We do anticipate that's going to increase by 50%, but that's still a very low rate, especially compared to some of the other areas. But that points to the fact that this is not as much of a coastal, not as much storm surge issues, and also it's a newer asset. So the construction type allows for stronger, lower risk relative to the insurance. So that all being said, great asset, something we really like. We're seeing this thing's, I think, going to probably trade a little bit north of where we are thinking, and probably is going to deliver a 5 or 6% cash on cash in year one. So that's really attractive to the right owner. I would imagine an institution would be all over this. Great cash flow, stable asset, occupied, low bad debt, all the hallmarks of a strong deal if it could be bought at the right price. Yeah, that covers that one. All right, so the next one, we're going to move from North Carolina down to South Carolina. We have another marketed deal, a little bit, not necessarily a super target. We would consider this to be a tier 2 deal for us. Size-wise, 250 to 300 units. Average unit size is between 800 and 900 square feet. And we're looking again at an 80s, 90s vintage property. South Carolina, right, in our experience, we're vertically integrated, and we've got some really great experience on our team historically from property management perspective, and our team has managed dozens of assets in the South Carolina area, and it is a difficult environment to operate in, and has been especially more and more difficult as we went through COVID and then come out of COVID. So it's definitely a market that we are keeping a close eye on, but we're not necessarily diving head first just because of our historical context relative to the difficulty of operating assets and collecting rent and just the tenant base and tenant behavior overall. So definitely biased to North Carolina versus South Carolina. Obviously within each state, we also have our opinions and our buy boxes, but just something to be that we always are looking at is how well are our tenants going to behave? Are they going to pay their rent? Are they going to be, and are we able to find good staff? That sort of a thing, because at the end of the day, the people are what make the property, and usually not the other way around. So that being said, the ask price here is also relatively high versus what we would feel comfortable with. This particular buyer purchased this property about 10 years ago. This is typically a situation where we are able to get a good deal, or at least the deal will clear the market. That's one of the positives about deals that were bought more than 5 years ago. Typically people have some equity, and if they're making a decision to sell, they've already rationalized that. And basis for the existing owner is relatively low, under $100 a square foot. And again, given this is an 80s, 90s asset, that's a pretty good basis for them. We are at 75 cents on the dollar relative to their ask, though. They're looking for $150, $160 a square foot on their exit. There is some comparable support for that from a price per unit perspective. However, the cap rate going in on that basis would be very low, below a 4 cap, at least based on our numbers. We're also seeing there is some bad debt. It's not too bad. And in the most recent period, it seems like they've really gotten some control over bad debt, which is great, but it's definitely something we need to be considering. Outside of that, taxes in South Carolina are relatively high. So we're looking at taxes once we're on the other side of the sale, and that's even at our price point, somewhere around 17% of total income. And if we go to their ask price, it'd be over 22% of the revenue. So that's very expensive. That's getting to property tax levels that we would see in Illinois or New York or other really high property tax burden states like maybe a Texas as well. Really high tax burden. Insurance also relatively high. So these are some of the reasons why it's a little bit difficult to operate in these environments. Property taxes tend to fall a lot on commercial property owners in these areas. That is usually driven by attorneys that are hired by the school districts to pull and get more money out of commercial real estate versus residential real estate. Not necessarily a bad thing, but it's just something you need to be aware of, and that 75% of every tax dollar is typically going to the school districts. And so they're incentivized to pull as much money as they can from the commercial real estate side of the business or tax base and not burden the residents who are the people who are actually voting. Whereas the commercial real estate folks are probably not living in their area and are not on the vote rolls. And then with insurance, that's really a function of just a lot of claims related to liability and things like that. So we do see, as a contrast from North Carolina to South Carolina, and this is also a little bit of an older property, 80s versus 90s, we think that the insurance can be over $1,000 a unit, which when you put that together with the taxes ends up being a relatively expensive fixed cost that it's difficult for us to control. Additionally, I will just note that if we could get this property 80s vintage in this market for about $120 to $125 a square foot, we would find that to be very attractive. It would allow us to get a 6% cash on cash in year one. That's what we're shooting for these days. We want to see 5 to 8% in year one. We want to be clearing the pref, which is 7 or 8% by year two. And so we're working on those assumptions. What I do like about this, again, we're not hitting even close to the ask, is that we do want to see a 7.5 or so yield on cost by year 4. We are hitting that, but of course, we're only hitting that at 75 cents on the dollar. If we go at the requested price, our yield on cost at year 4 is under 6. So really difficult. We want to keep a big margin of safety between the risk-free rate and our yield on cost. And we typically want to see that between 300 and 400 basis points over the 5-year treasury. And so with the 5-year treasury as of today, somewhere in the 380 range. So we definitely want to see our yield on cost over 7 by year 4. And we want it, the older the property, the bigger the execution risk, the higher we want that yield on cost to be by year 4 to create that margin of safety and get compensated, and have our investors be compensated for the risk they're taking. And yeah, the last thing I'll note here is just they've got a pretty significant amount of other income on this property, $130 to $140 a unit a month. That's pretty high, and we typically don't underwrite any increases in other income, and certainly in this case we would not expect to get more than that. So I think people can get caught up in trying to pick up a lot of dollars in other income. We prefer to try to pick that up through increasing value, higher rent rates, and really think about other income as a tactical thing that we can move maybe in years 3, 4, and 5 after we've made the big lift and shown the value to the residents. But with that, I think that covers everything. Okay, so our last deal for today, we're going to be moving over to Alabama. This is in Huntsville. Huntsville got a lot of liquidity came into Huntsville in the most recent peak. This deal is no exception. This is a great case study in what's happening in the market today. And so this particular deal in Huntsville, older property, 70s vintage, good unit sizes, 900 to 1,000 square feet each. Smaller property, between 100 and 150 units. Decent rents. This particular buyer purchased this property. Oh, before I get into that, income-wise, really great income, almost $100,000 of income. Household value about 250, and that's pretty stable across the 5, 3, and 1 mile radius. And renter occupied is relatively low, 19%, 20%, so looking pretty good. Vacancy factor so far as vacant units or vacant housing units is pretty low. We want to see that being pretty low. Otherwise, that can be an indication of maybe some distress in the market or just a transitional area. We will keep a close eye on all of that. Population growth has been positive. Unemployment is extremely low. A lot of really strong employers, and just economic growth as people have seen the benefits of living in some of these states that, like Alabama, that are really affordable relative to some other places with good weather and some other things they like. Now, additionally, the schools here are pretty good. We're elementary, on average, we're talking about an 8, 7s and 8s. That's very good. And so when I look at a good income, like the $90,000 income, 8s out of 10s on the school, low unemployment, good population growth, that tells me, hey, this is an asset that we really want to be looking at and taking a hard look at. So that, coupled with the fact that this was a 2021 purchase, probably means that this deal is going to trade, probably because it's coming against their bridge financing maturity. So this particular buyer purchased is all in for between 140 and 150 bucks a square foot. The property is, in our view, not worth that. And so we're really looking at somewhere in the $110 to $120 a square foot range for this property. We do believe it requires a decent amount of CapEx. But again, we're pretty close. We're at about 90 cents in the dollar. That usually gets us pretty competitive versus in today's market. This is a deal where there are a few other competing bidders, but given the size of the asset, I think we're well positioned to compete, be on the best and final sheet. This is something we'll track closely. Member equity to close is between 5 and 10 million, right in the sweet spot of what we to do. We'd be looking at agency financing right out of the gate here on a 5 or 7 year fixed loan. We probably, given the going in cap rate is in the high 6s, we're likely looking at full leverage, which is going to be close to 80% on this deal. I think we do have a loan quote already on this deal, and we're looking at something if I can just find this, probably in the low to mid 5% rate looks like a 5.16 rate, give or take. Obviously that's subject to change. 505 in this case. 130 spread, which is very attractive. We're assuming a buy down in that scenario. So when you do the rate buy downs, very similar to on the residential side, that has a reduction in the spread. You pay up front for that, but we are long-term holders, so we always will recover that fee. And it makes sense for us to pay that fee up front and roll it into the loan. And we actually net more proceeds, and we're essentially financing those additional proceeds through the loan. So it's attractive to do that, at least in today's environment, based on a circumstantial, situational basis. Additionally, here we've got very limited bad debt. They're doing a pretty good job of occupying the property. It's 93, 94% occupied. Expense-wise, in Alabama, we're seeing insurance is a little bit expensive. We typically expect 20 to 30% increases versus T12 on insurance. Sometimes we get lucky and it doesn't go up at all. But in this case, we always want to underwrite to a conservative level. But even at that point, at $1,000 is a unit, that's going to be okay. Taxes are relatively low in these areas. So we're talking under $1,000 a unit in most of the markets in Alabama, which is very helpful to the cash flow for deals like this. Where we do see a pretty expensive line item here, the only other really line item that's pretty expensive is going to be payroll. We feel strongly that the people at the site are the most important factor in success for these properties. You could argue that we maybe overspend to get talent and to overstaff potentially, especially in the beginning of a deal. But we feel like we need to get off to a great start, have great people executing our business plan. And that's over $2,000 a unit in our underwriting. But good other income here, good cash flow out of the gate. Like I said, we're pretty darn close to where we want to be on this. And yeah, we're going to take a hard look at this. And I imagine this one's going to come back, and we'll talk about this one again in best and final. I'm just trying to see if there's anything else that I want to take a look at. This property is about 2 hours away from other properties that we have. So there is some synergy. It's not amazing synergy, but it definitely allows our regionals or other management as they're flying into the area to be able to hit multiple properties in one trip, which definitely helps with travel expenses and the burden on our people to be traveling to a lot of different places at the same time. So really good property, definitely something we are going to take a strong look at and get an offer in at somewhere in the 90 to 92 cents on the dollar range. Yeah, this one will come back around, and we'll talk more about this one probably in the next couple of weeks. One last thing to just note, as I had said, Huntsville got a lot of attention in the most recent peak. And so what is that led to was a lot of deliveries, a lot of developers came in, built new units. And so we are seeing, although still very strong occupancy, a little bit of softening in occupancy as some of these deliveries are pushed through and absorbed by the market. This is a temporary condition with these deliveries, which can in some cases offer an opportunity for folks to buy properties that have a long-term, for owners that have a long-term perspective, but we certainly have to be able to model that appropriately. Typically, we're looking at 95% physical occupancy when we stabilize a property by year 3 or 4. In this case, given the new deliveries and given some of those pressures, we're going to be stabilizing at a little bit of a lower occupancy just to accommodate that and be a little bit more conservative. But again, we should see the burn off of the absorption over the next 12 months. But that's something that in these markets that saw a lot of interest, that where values really shot up, there was a lot of development. So it's something that we always are looking at, deliveries, new permits in our markets to ensure that we're not going to run into a situation where we're going to be competing against a Class A property with a 3-month concession. And given this is a 70s asset, we're looking at rents that are 1/3 in some cases, or certainly a half of what the ceiling is. So we're typically not competing with folks, but as the Class A or the premium brand new product gives 2-3 months concessions, that affects the 2000s build, the 90s build. They then have to do some concessions to get their units filled. And then all of a sudden people in this that would normally do a 70s product are saying, hey, for not much more money or almost no more money, I can upgrade to a 90s vintage property. And there's a big difference so far as look and feel between a 70s and a 90s vintage. Not only are the building materials different, but the ceiling heights are very different. The construction methods are different, how they're laid out, how functional the floor plans are, and then just the age and wear on the general components with an extra 20 years definitely changes the look and feel. So you do have to be concerned, even though this property is 50 years old, and you could argue, hey, it's not competing with the new construction, we are all living in the same market together. And so the ripple effects of new construction still can affect what we're seeing in the 70s vintage. And so you got to be really careful about that. In this particular case, the last thing I'll say about structure is that this particular buyer obviously bought at the peak, got caught up in that craze. And I think they're likely looking at a loss of, not a complete loss of equity, like I've seen for other owners, certainly, probably at least a 50% loss of equity from their purchase and basis to the next buyer. That's pretty common in today's market right now. Not surprised, but the fact that they are going to be able to potentially recover about 50% of their equity, not a great outcome, but better than a lot of other people that are in the market, which just tells me that I think either they bought it at a decent price, because I definitely saw a lot of 70s vintage deals in these markets go for $175 a square foot versus this one went for $140 back in 21. But because they're going to be recovering some of their capital, we don't have to worry about their ability to sell. A lot of the deals that we're seeing in today's market are at 100% write-off on the equity. And once you get to that point, once the basis of the property is below the debt, the sponsor is not really any more in effective control. And so they're not really in a position to be able to sell the property unless they can get a price that exceeds the debt. If the price is below the debt balance, then all of a sudden they're going to have to get approval from the lender. And so then that process gets very complicated and it becomes this big posturing battle between buyers and sellers and security holders, and attorneys get involved, and it gets complicated, and deals can take a lot longer to get done, and they're a lot more likely to fall apart. So they're great opportunities potentially, but they're a lot harder to get done. So in this case, I don't think that's going to be a problem, but it is a problem for a lot of other transactions that are trying to get done in today's market. Really good deal. We'll keep an eye on some of those market specific factors as we do our underwriting, but we'll be taking a nice swing at this one. Thank you for joining us on the Deal Flow podcast. We're here every single week sharing our perspective on the market, what properties we like, which ones we don't. So tune in next week and we'll be going through a few more properties that are on our list, include some HOA deals, some deconversions, some properties in the Florida market, as well as some of the other areas that we pursue, some both off market and on market. So tune in next week and you'll get a taste of what's going on in the real estate middle market for apartments. Thanks for joining us, and don't forget to like and subscribe.